What's up everybody? Gen X Dividend Investor here. In this video I'm going to tell you about 11 cheap dividend stocks that have at least 10 consecutive years of dividend increases, all of which I and professional analysts estimate are at least 20% underpriced, and 4 of which I own, and a bunch of which I've never talked about before. Of course, that doesn't mean you should run out and buy or sell anything without doing your own research. I'm not a pro, and me calculating that something is underpriced doesn't mean it's guaranteed to go up in the short term. And be aware that this isn't a stock analysis video. I'm just going to be sharing a few relevant pieces of info about these companies, but you should always dig much deeper to understand a business's financial statements, trends, risks, competition, etc. before ever doing any trading. And as a final disclaimer, don't take this as accurate investment advice, but please do punch that thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, I'll be sharing these stocks based on alphabetical ordering of their sectors. At the end of this video, I'll explain something I've shared in previous videos, which is how stock prices gravitate towards intrinsic value. So I'll be sharing 2 prices for each stock in this video. The first price will be what I calculated a stock's intrinsic value will be based on financial trends and estimates, and the second price will be the average or median price of what a bunch of professional stock analysts forecast a stock's price will be at 1 year from today. I know that some of you don't care about analyst estimates since they are often wrong or are biased, but I'm also biased and I make mistakes, and I personally find value in hearing what experts think. Anyways, a goal of yours should be to buy good companies when they're underpriced by the market, and recognize that Mr. Market can misprice a stock for years, but eventually long-term business performance always gets reflected into the stock. Okay, I created this video in the beginning of April, so prices might have fluctuated from when you're watching. The first stock in my list is Leggett & Platt, ticker LEG, a stock I highlighted in green because I'm long in it. They're a consumer discretionary company that specializes in bedding products and furniture and such. They recently became a dividend king, but also fell out of the S&P 500 as their market cap is too low. The pandemic has driven up their costs and has caused supply chain issues, and thus their performance in stock has been hurting. My 1-year fair value target price for LEG is $45, which is about 27% higher than it is today, as compared to analysts who have it at $45.50, which is almost 29% higher than today. LEG has a nice 4.73% yield, which is among some of the highest for the dividend kings, has a 61% payout ratio, a mediocre 4.4% 5-year dividend CAGR, and an awesome 50 consecutive years of dividend increases. LEG is taking it in the shorts due to inflation, and it has some other risks due to China. A company like LEG is nice for retired people like myself who enjoy its income, though I wouldn't push it for my kids' custodial accounts. Okay, let's move on. The next stock in the list is another I own, and that's Starbucks, ticker SBUX. My 1-year fair value target price for Starbucks is $115, which is about 37% higher than it is today, as compared to analysts who have it at $117, which is about 39% higher than today. Starbucks has a relatively low 2.33% yield, a 56% payout ratio, a great 15.9% 5-year dividend CAGR, and an okay 11 consecutive years of dividend increases. Starbucks has been facing some headwinds from unionization efforts which have been succeeding. Recently, Howard Schultz came back on board as interim CEO, and he suspended buybacks, and the market wasn't too happy about that, but he's focused on making them stable for the long term. So is their dividend at risk? Well, any dividend is always at risk, though I'm still a Starbucks bull and I'm liking it at these prices. Okay, let's move on. The next cheap dividend stock on the list is Best Buy, a new stock to the series. My 1-year fair value target price for Best Buy is $120, which is almost 30% higher than it is today, as compared to analysts who have it at $125, which is 35% higher than today. Best Buy has a nice 3.89% yield, a great 30% payout ratio, an amazing 20.4% 5-year dividend CAGR, and 19 consecutive years of dividend increases. Either way, I love shopping at Best Buy, kind of like my wife loves shopping at Target. But management is driving towards online purchases more, and thus less profitable stores will probably continue to close. Management is also trying to expand revenue by pushing into the healthcare tech space. Their margins have been slipping a bit, and they're investing more into technology as well as our remodeling, which will further impact margins, but both are the right long-term moves. They've had some additional challenges due to pandemic-related supplies along with staffing issues, thus sales issues. Anyways, they did around a 26% dividend increase this year, so these guys are shareholder friendly. Overall, a pretty interesting company that's probably worth digging into. Okay, let's move on. The next stock on the list is a sin stock that I recently got into, and that's British American Tobacco, ticker BTI. My 1-year fair value target price estimate for BTI is $60, which is about 42% higher than it is today, as compared to analysts who have it at $53, which is about 26% above today's prices. BTI has a high 6.92% yield, a 68% payout ratio, a decent 6.3% 5-year dividend CAGR, and 20 consecutive years of dividend increases. Since stocks like this face tons of headwinds from more health-conscious populations to risk of regulations impacting their earnings. Of course, BTI is trying to evolve by offering more combustible-free products. I think long-term we can see growth from their newer products like vaping along with things like cannabis. They also face some geopolitical risks from the current Russia-Ukraine markets, though that's a relatively small impact to their total revenue. Some big funds have dropped sin stocks lately, so that's another risk to be aware of. Okay, let's move on. The next stock on the list is the First Financials one, and that's Franklin Resources, ticker BEN, an asset and wealth management company. My 1-year fair value target price estimate for BEN is $40, which is about 44% higher than it is today, as compared to analysts who have it at $36, which is about 29% above today's prices. BEN has a nice 4.15% yield, a 28% payout ratio, a decent 8.5% 5-year dividend CAGR, and 42 consecutive years of dividend increases, and are part of the elite dividend aristocrats list. Franklin Resources has struggled to grow their top and bottom lines in the competitive financial landscape they operate in. Their fees have gone down as more investors go into ETFs and cheaper mutual funds, and their funds haven't been performing as well as they'd like, and they face some risks from regulation, like many in their industry. Their overall assets under management has been struggling, though some recent acquisitions may hold promise. They're implementing some new projects to increase their efficiencies, so time will tell how they do as compared to the next stock on the list, which is a competitor of theirs, and that's T. Rowe Price, ticker TRO. I actually used to have one of my old 401ks at T. Rowe, and actually just got an email from them as I was doing this video. My 1-year fair value target price estimate for T. Rowe is $185, which is about 20% higher than it is today, as compared to analysts who have it at $195, which is about 26% above today's prices. T. Rowe has a decent 3.08% yield, a 34% payout ratio, a great 15.2% 5-year dividend CAGR, and 35 consecutive years of dividend increases, and are also part of the elite dividend aristocrats list. One important item to call out for everyone is that recession signals are looming, with credit markets getting tougher and rates going up and yield curves looking ugly. Recessions often mean a weaker economy, which is usually problematic for investment management companies, because weak economies usually means a weak market, which usually means less financial returns. But T. Rowe is a profitable company and has some nice financial trends that are worth digging into. Okay, the next stock on the list is another financials, and it's Goldman Sachs, ticker GS, which is a well-known investment banking and wealth management firm. My 1-year fair value target price for Goldman is $450, which is about 39% higher than it is today, as compared to analysts who have it at $424, which is about 31% above today's prices. GS has a low 2.42% yield, a nice 13% payout ratio, an awesome 20% 5-year dividend CAGR, and 10 consecutive years of dividend increases. I think the current economic and geopolitical climate brings uncertainties to Goldman. If we had a bad recession, then buckle up. Regardless, Goldman is the most premier investment company in the world, so they tend to come out on top in the long run. Dig into their price to book as compared to their peers for more insights. Okay, let's move on. The next stock on the list is another I own, and that's JP Morgan Chase. My 1-year fair value target price for JPM is $175, which is about 31% higher than it is today, as compared to analysts who also have it at $175. Nice, we agree. JPM has a 2.96% yield, a nice 25% payout ratio, a good 15% 5-year dividend CAGR, and 10 consecutive years of dividend increases, along with an incredible CEO in Jamie Dimon. Okay, moving on. The next stock is in the industrial sector, and it's called Abm Industries, ticker ABM, and provides janitorial, facilities engineering, parking, custodial, and other services. My 1-year fair value target price for ABM is $55, which is about 20% higher than it is today, as compared to analysts who have it at $62, which is about 35% higher than it is today. ABM has a low 1.69% yield, a nice 22% payout ratio, a low 2.8% 5-year dividend CAGR, but an amazing 54 consecutive years of dividend increases, making them a little-known dividend king. ABM has done a good job growing its earnings per share for quite some time, though I wouldn't call it a high-growth company. I like the fact that it's boring and under the radar, just a steady eddy moving along, but one that is cheap right now. Okay, let's keep trucking along. And I mean that literally because the next stock is Cummins, ticker CMI, a company that makes engines and other components. My 1-year fair value target price for CMI is $260, which is about 30% higher than it is today, as compared to analysts who have it at $265, which is about 33% higher than it is today. CMI has a low 2.89% yield, a nice 38% payout ratio, a decent 7.1% 5-year dividend CAGR, and 16 consecutive years of dividend increases. Cummins is positioning itself to operate in a world with EVs, and they have a bunch of zero-emission powertrains for trucks, buses, trains, and construction equipment. Their recent acquisition of Meritor speaks to how they continue to position themselves. I think they're another boring play that people are ignoring right now, but probably should be looking at more closely. Okay, the last stock on the list is another industrials, and that's good old Stanley Black & Decker, ticker SWK. Hopefully everyone recognizes them for their power tools, though they have other product lines. My 1-year fair value target price for SWK is $180, which is about 27% higher than it is today, as compared to analysts who have it at $204, which is about 45% higher than it is today. SWK has a low 2.24% yield, a nice 27% payout ratio, an okay 6% 5-year dividend CAGR, and an amazing 53 consecutive years of dividend increases, making them a king. They face some headwinds due to the pandemic, and their debt should be watched, though they have good investment credit ratings, and they're buying back shares and have plans to grow their revenue significantly this year. They're another one that seems to be flying under the radar. Okay, now before I tell you about my thoughts on intrinsic values and stock prices, I wanted to share a few other dividend stocks that I feel are worth digging into, but that didn't meet all my criteria. They include Tyson, Walgreens Boots Alliance, 3M, Altria, Enterprise Product Partners, Bristol Myers Squibb, Cardinal Health, Amgen, and Merck. Okay, now let's talk about intrinsic values. Here's a picture I made to show you how stock prices and intrinsic values usually work. I'll explain the pick in a moment, but it's important to understand that there's lots of ways to value a stock, and one of the good ones that you can usually use for dividend companies are discounted cash flows. There are multiple videos on YouTube about discounted cash flows and calculating intrinsic values of companies if you feel so inclined. It's important to understand that regardless of what a stock's actual intrinsic value is, the market can often overprice it or underprice it, but in the long run the market gets it right as stock prices trend back to a company's intrinsic value. So I like to think of a stock's intrinsic value like its gravity or it's a magnet, as it's constantly pulling its stock price back to it. This was summed up in Benjamin Graham's famous saying, which was, in the short run the market is a voting machine, but in the long run it's a weighing machine. Voting represents how people are using their dollars to either buy or sell a stock, thus a stock's price is often a popularity contest in the short run. However, in the long run the stock price trends towards its intrinsic value, which is analogous to saying that market forces slowly properly price a stock, i.e. its real value is properly weighed and thus priced by the market. In the short term, the gravity of intrinsic value can lose out to more powerful forces like news headlines and world events and Reddit warriors. The market often overreacts to good news or bad news, which value investors can then capitalize on. What I mean is that people often buy or sell based on emotion rather than on business fundamentals, which is why stock prices can do seemingly crazy things. But in the long term, gravity and physics and reality wins, and stock prices trend towards actual intrinsic values, which are based on business fundamentals. That concept is super critical to understand if you want to be a good investor. It also helps explain why certain things can be overpriced or underpriced for years as stocks are popular or unpopular. Eventually, business fundamentals win. If good growth comes, eventually the stock will respond. It can take a long time for people to forget about hated stocks or beloved stocks, but eventually they do if the company performs or doesn't perform. That's why a crappy stock can shoot up for a while, or a solid company can trade in the dirt for a while. Your goal is to be able to identify when quality companies are cheap, and then buy if it makes sense to you. Or perhaps sell it if things are too expensive. It all depends on you. Another gravity example I like is that dividend income is like the fuel or thrust of your personal rocket, a rocket which is trying to break free from the gravity of your expenses. Once you have enough fuel and thrust, aka dividend income, to break free from the gravitational forces of your expenses, then you blast away from your old life on Earth and you can fly away faster and faster into space with the freedom of your time. Okay, now back to the picture. The purplish blue line is the intrinsic value, i.e. my target price, i.e. it's a magnet or its gravity which is trying to pull the black line, which is stock prices, towards it. In this example you can see an intrinsic value estimation that goes up and down as time goes on, and is slowly trending up like most quality companies tend to do over long periods of time. The black line, aka a stock's price, tends to fluctuate wildly based on short-term news and headlines. The ideal time to buy a stock is when it's underpriced, which is represented as areas of red where the stock price fluctuates under its intrinsic value price. Now, if your strategy is to buy and hold for generations, then buying at any stock price can work out. It's just that your returns will be less than if you buy when something is on sale, and it can take materially longer to get a good return if you just invest whenever. Similarly, the best time to sell is when it's overpriced, which is any period on this graph along the areas of green, because those are all times when the stock price is higher than the intrinsic value. This example chart could represent 20 years of stock prices, so you need to understand that something could be underpriced for years or overpriced for years, but stocks eventually tend to trend towards their real intrinsic values, which you can calculate with discounted cash flow calculation, and sometimes by analyzing price to earning trends. A low PE ratio doesn't automatically mean a stock is undervalued, and a high PE ratio doesn't necessarily mean a company is overvalued, but a 15 PE is often a reasonable valuation for most, but not all companies. So as earnings go up, then stock prices tend to go up, broadly speaking. A conclusion you should draw from this picture is that the difference between a stock's current price and its estimated intrinsic value becomes your investing opportunity, assuming you believe the intrinsic value is a good estimation, and those who do invest like this are known as value investors, since they are transacting based on some form of fundamental business analysis, which attempts to calculate a stock's intrinsic or book value. Book value and intrinsic value are two ways to measure the value of a company, and there are a number of differences between them. But basically, book value is the measure of now, and intrinsic value leverages forecasted estimates of the future. Of course, don't day trade thinking you can guarantee a stock's movement based on any of this. I'm telling you where I think stock prices will trend over time, which is basically useless for day traders. Thus, this is meant for buy and hold investors. It also means that when I share stocks which I feel are undervalued, it means I think it will just be a matter of time until they revert back to their proper intrinsic value trend lines, though I have no expectations of price movement in the short term. Okay, now I'd like to shout out my latest Patreon aristocrats and kings who've signed up since my last video. So first thank you goes out to Wasted Noon Craft Brew for upgrading to a king. I recently put a limiter on how many people I'll let sign up as my tier Patreons. Patreon kings get all the perks of my lower Patreon tiers and let you have a monthly private voice chat with me to talk about whatever you want, such as your dividend portfolio or whatever, which is why I limit the number of people I let sign up for it. I only have a couple slots left at the King tier since I can only handle so many calls each month, so sign up now if you're interested. Okay, now I'd like to call out the Patreon aristocrats who've joined since my last video. So thank you G. Milos for signing up. Thank you Bailey for signing back up. Thank you Tarko Bless for signing back up. And thank you Networked, who actually signed up for an entire year, which gets them a 10% discount relative to paying month to month. Adding a discount for signing up for a year was the suggestion from another aristocrat member of mine named Rack and Jack. He was actually the first person to sign up for a year, so thanks Rack and Jack. Also thank you Matatu73 who signed up for a year at the discounted rate. And finally thank you SH4132 who also signed up for a full year. Aristocrats gain access to my Dividend spreadsheet product that I use in my videos, and they get to be in multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them publicly on YouTube, as well as they get to vote on which thumbnails I use for my videos, and of course they get more direct access to me. I still have a few slots left open at the Aristocrat tier, so sign up now before all the slots are gone. And if you made it this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and it's growing all the time. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.